Hello, trader friends. In this video, I'm going to teach you one of the most important skills every successful trader has to have. Every successful trader that I know understands how to roll in an down and out, how to roll to another expiration, how to roll down, how to give yourself more time. And this is going to make you a lot of money in the future if you learn how to do it correctly. So let's get to it. Before we begin, let's think about it. Why do we have to roll something down and out? If we have to roll something down and out, that means our trade is in trouble. That means either the market went against us, volatility went against us, or we did a dumb, stupid trade. One of those three. I don't know what you guys did, but if something goes right, there's no need to roll down and out because if something goes in our direction, we're making money, and then what we have to do is take that trade off. And what a better way to illustrate it than let's go directly to our Tasty Trade platform and see what we're talking about. I've heard everybody's comments about you wanted me to hide my beautiful face in the videos, and I'm going to do that. And my apologies for everybody who had to watch me while I was showing the platform before. So first of all, let's do a basic short put trade. If we follow Tasty Life commandment and Tasty Trade commandment, what we do is normally we place trades 45 to 60 days out. So, and I like to use the monthly expirations. First of all, I'm going to look at the March expiration. It's 54 days out. Bingo. I like that. It's between 45 and 60 days. Check. Number two, I like to see the levels where I can sell my put. And I like to see, you see the Tasty Trade platform shows in this grayish color, brownish color, the expected move. And the expected move 54 days out, it's 46.65 on the downside, and it's 5015 on the upside. So it's a pretty nice wide range. Not humongous, but it is a nice range. Then the first dotted line gives us the one standard deviation, which is normally 67% probability of profit. And this is located at the 45.75. And then what's beautiful about Tasty Trade, it's very easy to find the second standard deviation, which is around 93-94% probability of profit. And we can find that at 43.05. So let's pretend we're going to do a bread and butter Tony short put, 45 to 50 days out. I normally like to sell stuff, a little further out than the expected move. I like round numbers. So let's choose 46.50 just for fun. I like $30. A $30 credit is nice. So we have placed our trade. Let's pretend we sold this put on SPX for $30, expiring 54 days. We're collecting $3,000, and the computer is asking us for $77,810. Remember, Uncle Tony likes to trade SPX, but there are four flavors to trade the indexes. SPX is the big daddy, ES is the medium daddy, SPY is the small daddy, and MES is the mini daddy. So you can choose any of those four items. And to refresh our memory, you see that $77,000. That's $77,000 if the market goes against us, either the market going down or volatility going up. That amount of money that the computer or the brokerage house is asking us to place as collateral for the trade will go up. And let me demonstrate that. Let's move our short put to at the money. And instead of $77,000, now the computer is asking $96,000 to place this trade. And if we go a little bit in the money to the 4,900 trade, now the computer is still asking us for almost $97,000. So you can see that even though the computer is telling us that the initial capital required is $77,000, my planned capital should be around $97,000 just to be safe. And you can round that to $100,000. Now, if everything goes right, what are the Tasty Trade or Tasty Life commandments? We're going to take this trade off at a 50% profit or at 21 days to expiration. So what does it mean to take our profit at 50%? It means that when this put that we sold for $30 is worth $15, we're going to take that put out. We're going to take it away and we're going to take our money. We're going to take our profits. And what does 21 day mean? It means that if we sold it at 54 days and mm, and we're going to have to take a big look at it when we have 21 days left, and that means we can stay this trade safely for around 30 to 34 days. Now let's go back to our trade, and so let's say everything went well. You know, the market went down a little bit, stayed flat, went up a little bit. Time passes, and we were able to collect our 15 points, and we made our $1,500, and everything is well. But not always this happens. And this trade was shown to me by one of my dearest friends, my friend Bobby Lee. He is friend of mine from New York. What a great guy! What an amazing trader. He's no longer with us, and he's also a great friend of Tom and Bat. And he taught me a lot of things on trading. So I wanted to mention him in this video, and so he knows I'm thinking about him. And he taught me a lot of skills. And following videos, I'm going to teach you more. Bobby Lee, man, he was so smart. He made me a lot of money during my time. So let's go back to our put. Let's say we sold a 40/50 put for $30. Let's say the stock market starts to go down. When does Uncle Tony like to roll puts down and out? And what does rolling down and out really mean? What rolling down and out really means is closing your current trade for a loss, yeah, for a loss, and reestablishing another trade with a better probability of profit, with a with an additional credit, and to give us more time to be right. And why should we do that? You know, in my point of view, you know, normally the stock market goes up, or when it goes down, it doesn't go down hard, but sometimes it doesn't. So this strategy or this skill that I'm teaching you right now, you're gonna use only if a couple of things happen. Let's go back to the platform. Number one time when we roll down and out. Number one time when we roll down and out is if the S&P goes down to our strike price. So let's pretend right now the S&P is trading at 48.40. So let's pretend that we have sold the 48.40 put, which is right here. And let's pretend we sold that put for $30, and the stock market went down crazy, and now our $30 put is worth $72. So now we're losing around $4,000, and we are in our pants, definitely. But you don't want to take your loss because normally the stock market bounces up, and normally they manipulate the market up. Don't tell anybody I said that. But you've seen the market. It's rarely that it stays down. Even during COVID, it was only down for 23 painful days. So let's grab this example and let's pretend that we sold our put further down, and now the S&P went down to 48.40. So we're losing $4,000 on our trade. Another one of Uncle Tony's rules is death before debit. What does death before debit mean? That I'm always going to try to make all my adjustments for a credit. Why? Because it's easier on my brain. If everything I I place this for a credit, I know I have not paid any vega, I have not paid for any extrinsic value, and I have more chance to be right. So the first thing that I'd like to do if the S&P goes to my strike, in our example, that means the S&P went down to 46.50. But now, for example purposes, I'm gonna pretend that the at the money is 48.40, and it's $70. So we're losing $4,000, and I'm not happy. So I'm going to do is buy this put right now and pay $72, which is painful, and then go to a further out expiration. You can go out 1 month to April, you can go down to May. Depends how confident you are that the stock market will bounce. But in order for us to make it, I normally like to roll out 2 months. And some people like to roll out 1 week, 2 weeks, a month. Uncle Tony likes to roll out 2 months out because once I roll my foot, uh, I want to be, I don't want to be worrying about this for at least for the next 30 days. And if our rule is death before debit, what do we have to do? We have to find a put that is worth, if this one is 72.90, we have to find a put that is worth $73. Why? Because if we sell something for $73 plus, we will get a credit. So what I'm going to do here, because the stock market is closed right now, I'm using my theoretical value. And remember, I like round numbers. And let's try to see if I sell the 4,700 puts, which give us will give us 140 points down. Why 140 points down? If you take a look at here at my bracket order in the basic platform, you can see I'm buying the 4840 put for $73, and then I'm selling the 700 put for $71. So this trade is giving us $140 cushion, uh, and also 60 days more to be right, but it's not giving us a credit. So this is something Uncle Tony will not do. So what I like to do is I will try, because I like round numbers. I will try the 4720 put. If I sell the 4720 put for $75, and you can see here the computer is telling us that we are going to get a $3.30 credit. So remember, we originally sold the put for $30. That's in our pockets. Now we're getting three additional dollars, right? So that's $33 in our pocket, and we're moving our put down to all the way down to 4720. If you're getting a little bit confused, don't. It's very easy. And I want you to grab a pen and paper and write these numbers down because they're going to help us. Uncle Tony has a little piece of paper. So number one, we sold our put for $30 in our pocket, right? $30. All right. Number two, we're rolling a put down for a $3 credit. So that's another $3. So we have $33 in our pocket. Now, number two, let's go back to our beautiful trading platform. And if we sold our original put for $30 and we're buying our losing put for $73, right? How much are we losing? So we have 73 minus 33. We're losing 40 points. And I want you to grab that number down, 40, and write it down on a piece of paper. Why is this number important? Because, when I roll down and out, I want to be able to take this trade off when it's a winner, a small winner, or at least break even. So, once again, we sold our put for $30. We rolled for another $3 credit. So we have $33 in our pocket. Now, we closed our losing put for $73. That means we lost $40 on that put, and we're reestablishing a new put for $75. The only difference, boys and girls, is that we're selling that other put 120 points down. That's why people say I'm rolling it down and out, down and out. That is what rolling down and out is. And so, how do I find my break even? Going back to our fabulous Tasty Trade platform, you can see the trade that I'm doing. I'm closing our original put that we sold and paying 73, and I'm selling the new put for $75. Now, if we sold this put for $75, right? But we already have $40 in our pocket. What does that mean? That means that we can take out this put at a profit when. Let's use our brain. Let's do a little bit of math. So if this put expires worthless, right? If this put expires worthless, we would make $7,500. We lost $4,000 on the first one, right? So we would actually make a profit of $3,500. So our break-even point is very easy. Whenever our new put that we have, because this put, once we roll it, it's gone. Once this put that we sold for $75 is worth $40 less, which means when it's worth $35, we can close this trade for a break even. And what you can do, you can even place a trade GTC order to close the trade at maybe not $35. Like I like to do is I like to make I'm greedy. I like to make a few extra cents. So maybe I'll close it when this trade is when this put is worth $30, $29. Well, if I took the time to sell my original put, took the time to roll it down and out, and kept this trade on for 2 or 3 months, I at least want to put a little bit of money in my pocket, right? So I'm probably going to put a GTC order to close this trade down when this put that's worth $75 now becomes $29. And then I will take gladly my 400, 300, $400 profit, and we will be done with it. So if we are lucky enough to roll our put down and out, we rolled it down 120 points down, and we collected an extra $3 in order to move it down. And the market went down up, or it stayed flat, and our put is now worth $29. Hey, great, we're out of the problem, and we're happy, and we saved ourselves a loss. But what if? Always what if? What if my grandmother had wheels? Well, she wouldn't be my grandmother. She would be a bicycle. So everybody's asking me all the time, Tony, what if, what if, what if? What if the stock market keeps going down? Hey, no problem. If the stock market goes down to the 4720 level again, what are we going to do? We're going to buy that put back, and then we're going to look for another put 2 months further out and sell that put for a credit. Maybe hold that out. Maybe we're going to be able to move that up to, move that down to maybe the 4,500 level for a credit. And then we have to keep our calculation, $30 of it, of our initial credit, $3 for our roll. Maybe we'll get 2 or 3 extra dollars for this roll too. So now we're almost up to 35, $36, maybe $40 in credit. And that's how you calculate how you're going to calculate all the credit received, and then you're going to calculate all the losses. But what if I'm bad at math? If you're bad at math, don't worry. Tasty Trade has something called options chains. And what is an option chain? An option chain is, instead of writing it in a little piece of paper like I do, the computer keeps track of all the credits and debits that you did in that trade. Isn't that crazy? Isn't that amazing? That's why Tasty Trade is the best trading platform out there. So remember, we rolled it down and out when our put hit our at the money strike. Now, if you let it go in the money, don't worry. If you put a little bit in the money, roll it. The problem here happens if you let it go really, really, really deep in the money. What do I mean? What about if you let the put go, 50, 100 points in the money? Then the amount of credit you're going to take is going to be less. Then you probably won't be able to roll it down and out. And 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 that's not going to be good. That's why you have to be vigilant and look at all your units. I all my naked short positions are golden units, and see the levels where you sold them. And if you see any one of them getting in trouble, you can roll them down and out. Now, what about if I am a baller? I am a very aggressive trader, and I don't need an extra cushion. I want more money. So the second way you can roll a put is not rolling it down and out, but rolling it to the same expiration. So let's pretend we sold the 46.50 put, right, for $30, and now it went into the money, and now we're going to roll we're gonna roll to the 46.50 again. Why? Because because I'm stubborn. Some people are stubborn. They think that level has to hold. And I said, okay, if you think that level has to hold, hey, stay at that level. Uncle Tony likes to roll it down and out. If you want to be aggressive, take a look at my beautiful tasty trade plan. If we roll to the exact same expiration, so we're rolling the 46.50 put, we're closing it for a loss, and then we're opening another one at the 46.50 level, we see that we're going to get a $32 credit. And how do I do the math, Tony? Well, it's very easy. First time you sold it for $30. Now you're getting a $30 credit. So you put $60 in your pocket and you have the 46.50 strike. And your break even, if my math doesn't fail me, is 45.90. Why? Because 45.90 plus my $30 original credit plus my $30 credit I got on the roll, it's $60. That takes me to 46.50. So if you're more aggressive and you don't think the stock market's going to go down further, hey, I don't care. Roll it to the same exact strike price and collect more money. See, roll down and out. Some people are more aggressive. They like to roll to the same exact expiration. Uncle Tony likes to give more cushion. I'd rather have a $3 credit and have a 120 point cushion. Some people want no cushion because if you're already rolling it at the money, most likely the stock market will keep going down and then you will be in the money. And I know you have a $60 cushion in our example, but 60 points in a down market could be, 1 hour, 2 hours, who knows? I'd rather move my put down 120 points down, get $3 credit, and then manage it that way. I can already see the question. Hey, Tony, does this work with calls? Sometimes. Why sometimes? Because calls, one of Uncle Tony's rules, never sell a naked call. Although I sometimes, often do sell a naked call, especially on a 1 to 0 upside call ratio. I rarely sell naked calls. Strangles, I like strangles. They're not my favorite trading strategy, and I like strangles if you don't sell the call. That's a joke, inside joke, trading joke. Strangle that you don't sell the call, it's called a naked put, right? So if you are stubborn and you did sell the call, then you were going to find out some very sad fact, some very sad truth. Number one thing you're going to find out is that sometimes to roll it, you will have to pay. Not always you can get a credit. I wish I could tell you can get a credit, but not always. Number two, the stock market most often bounces up. Why? Because they're printing so much money that things are money's worth less and less. So the stock market will tend to go up in nominal terms, at least in nominal terms. And sooner or later, the stock market's going to go up, and your in the money put, you know, will be okay because the stock market bounces. Now, on the upside, you can never get it back. I've had several times. I have rolled puts 18. I mean, I have rolled calls for 18 months because I'm stubborn and I've been paying debits and stuff like that, and they never came back. So that's one of the reasons I don't like selling calls because they're very difficult to roll up and out. If we roll puts down and out, calls we roll up and out. And I've never seen anybody who could roll it up and out. I can see you rolling it out, meaning rolling it to a next expiration. But rolling it up and getting a credit, that's very difficult. And why is it difficult? So let's go to the Tasty Trade platform, and I'm going to show you something very, very interesting. So you know that each strike price has its own implied volatility. If you see my mouse here, you can see that I'm clicking the implied volatility column. And I want to show you a big difference between calls and puts. So if we go to the at the money, the implied volatility of the at the money put is 11.67. If we start rolling down, pretend we're rolling it down and out, what's happening to the implied volatility? Implied volatility is increasing. That's weird. Yeah, the first time I saw that was weird to me too. But puts, because normally stock markets crash down, although I've seen a lot of stock market crashes. Normally, implied volatility increases while you go further and further and further out of the money. It's crazy. The implied volatility at the money was 11. The implied volatility at the expected move is 14. The implied volatility at the one standard deviation is 15. And the implied volatility at the second standard deviation, which is at the end of the world, at 4,300 strike, is 20. How can that be, Tony? Well, because that's why puts, people always are buying way out of the money puts. They're buying black swan puts, and that bidding or buying of puts really deep out of the money keeps implied volatility high and makes it go up as if we go further out of the money. Now, let's take a look at the calls. The money implied volatility for the call is very similar to the one at the put. It's 11.60. But if we start going up, implied volatility keeps going down. If we go to the 4,900 strike, now it's 10.96. If we go to the 4,950, we're 10.50. If we go to the expected move, now it's only $10. If we go to the one standard deviation, it's below 10. And if we go to the second standard deviation, it's lower. So as you can see, this is a very weird phenomenon. This phenomenon is it's called the put skew or the volatility smile. If you guys are trading nerds like me, why don't you Google the volatility smile? And Tasty Life has a lot of great research in there. And that you can see why implied volatility at different strikes is better. But don't worry. We're not here to learn how to make a sausage. We're just here to eat sausage, right? So as if you know that if you go out of the money on the put side, volatility goes up. And if you go out of the money on the call side, volatility goes down. That's all you need to know. That's why rolling down and out puts works and rolling up and out calls rarely. Now, there's another important bit of information that I have to tell. How long can I keep rolling my put down and out? Well, boys and girls, you can keep rolling your put down and out as long as you have money, as long as you have chutzpah, as long as you have cojones to hold on to the market bounces. But the most important hold off factor is money. That's why I'm always encourage you to trade with the least amount of money possible, to trade with the smallest product possible. You don't have to trade SPX, you don't have to trade ES, you don't have to trade 5, you can trade MES, right? If you have enough money to hold a position, to give you enough time to be right, sooner or later the stock market's going to bounce up, boom, and then the volatility will deflate, your put value will contract, and you will be able to either break even or get out of your problematic. So there you have it. And let's do a beautiful summary. Number one, if we sell and make a put, we're going to analyze two things for profit. Take it off at 50%, or we're going to take a hard look at it at 21 days. And at 21 days, if we didn't make our 50%, but we made 10, 20, 50, whatever percent, I would take it off. Take it off and reestablish it again. Okay. You don't have to make 50%. Now, if the stock market keeps going down and the tsunami is getting to your foot, if you can do it before your strike or when it's around the area of the strike, I would encourage you to buy back that put for a loss. And with that money that you're paying, let's say we paid $70, let's look for another put that we can sell further down and out for the for a credit, like the example that we did. The good thing about YouTube, you can start video, you can go down, and you can see how I bought back the put for $73 and sold another one for $75, giving me a $3 credit. Another thing, and keep the math, because once you keep the math and you know where your break even is, once I reach my break even, I put a GTC order and I cancel. If you're more aggressive and you think that the market will not reach that level, you can hold that put and suck up all the profit. Now, option number two, if you are very aggressive and the tsunami hit your foot. But you think the tsunami is gonna hit here? Good luck with that. Roll it to the same exact strike. Roll it to the same strike. One expiration down and collect a bigger credit. And write those two credits down on a little piece of paper. At least you know where your break even is. And lastly, implied volatility goes up the further you are out of the money with puts, and it goes down the further you're out of the money with calls. And in order to keep holding the dream, keep the dream alive, because rolling down and out is keeping the dream alive. In order to keep the dream alive, what you need is capital. And if you trade it small and you have enough capital in your account, you can hold that trade. And once you have managed that skill and you have this skill, you have no idea the power that gives you. Because I'm not scared of selling puts anymore. I'm not scared because why? If the market starts going down, no problem. I have enough capital. I'm going to roll it down and out. One, two, three expiration. If it goes down again, I'll roll it again. As long as I have capital to hold it, sooner or later the stock market is going to bounce, and I'm going to be able to get out of it. If you look at the stock market the chart, the stock market has always bounces up. As long as you have enough capital to wait it out, you will be fine. On the call side, no. On the call side, the market may never, ever, ever come. So there you have it. This is one of the most valuable skills you can have as a trader. It's a must-have in everybody's arsenal. I want to thank my friend Bobby Lee for teaching me this, many, 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 many months ago. And when he taught me this, I really it took the fear away of selling puts to me. And I hope this video takes the fear away selling puts to you. And that doesn't mean there's no risk. There's huge risk. And remember, these are not recommendations. These are not suggestions. This is just how I trade and how I learned to be. And if you want to make money, if you want to grow your pile, follow Uncle Tony and be kind. Subscribe, share it. If you think someone else can benefit from this video, share the video. It'll help me out a lot. I've been making a killing in YouTube. Thanks to you guys, I've been able to monetize my channel now. Only 4 months instead of a year. And since Sunday, I've been averaging $2 a day. So Uncle Tony has positive data. He's minting money in YouTube. In the first monetized week, I made $14. So thank you very much for $14. And God bless you all. And good luck trading to all. And remember, you got to risk it to get the business.